Welcome to the Hong Kong Retirement Schemes Association Educational Video Program 2023. I'm Penny, member of Media Event Task Force and Profile and Events Subcommittee, your host today. We are honored to have invited Anthony, Head of Hong Kong Institutional and Pension Business from Invesco, to the program. For this episode, we will discuss how to manage post-retirement assets.
Pleasure to be here.
Population aging is a common issue worldwide. In Hong Kong, the average life expectancy continues to rise, and about 1/3 of population will be aged 65 or above in 2038. In addition, the expectancy of life and birth for men and women was 82 years and 88 years respectively. The issue of aging is alarming. So, post-retirement planning is important to every one of us. Anthony, could you share with us what factors should people consider for the post-retirement financial planning?
Yes, sure, Penny. I think people should consider 4 factors for their post-retirement financial planning, namely first, inflation risk, second, longevity risk, third, consumption risk, and investment risk as well. So inflation risk is a big problem for retired people as it consumes the purchasing power of their savings. If you look at the inflation rate in the last 20 years since the launch of the MPF system, the annual inflation rate is around 1.8%. So in other words, if you place $1 million into your bank savings account without investing, the purchasing power is down to only around $840K after 10 years. That means you lose approximately $160K for doing nothing. People need to think about how to keep the purchasing power of their money and savings. The second risk to mention is the longevity risk. So longevity risk means that the risk of living longer than is currently expected and thus do not have enough money for their remaining life. According to statistics, the life expectancy of males and females reached a very high average of 80+ years old nowadays, and we could see that Hong Kong people are having longer life and more different types of expenses such as daily medical healthcare expenses. Sustainable income streams are important for people to maintain a quality retirement life. Consumption risk, the third factor, refers to the risk of underestimating the expenses needed in retirement. People may underestimate their retirement expenses by only counting the daily expenses needed and underestimate the expenses spent with their family, friends, traveling, etc., to facilitate their daily needs. This may speed up the consumption of their savings and turn out there's not enough money for the later stage of life. And again, people need to plan ahead for their income sources in their post-retirement portfolio. And the last factor is the investment risk, which refers to the risk of earning less than expected on savings accumulated to date. That's due to market volatility and also some of the financial events.
Thank you, Anthony. These factors seem important for people to think about the retirement. To encounter these factors or risks, what investment elements should be considered when constructing a post-retirement portfolio?
Yes, sure. There are numerous elements that people should consider when constructing their own post-retirement portfolio. The vital one is to have a well-diversified portfolio. So in the current Hong Kong MPF retirement market, we could see that the public has a tilt towards the home-biased investments. The allocation of the current retirement market would be considered a bit too concentrated and will be affected by the volatility of single market exposure. Just take Hang Seng Index as a proxy. The annualized price return since the launch of the MPF system is about 1.6% per annum, which was lower than the inflation rate and not too satisfactory at some point. So it is not too ideal situation for having a concentrated risk in the investment portfolio, not to mention having concentrated risk of both income and investment return. So retired people should build a well-diversified portfolio with low correlations, among different asset classes for a better risk and return matrix. So apart from having a well-diversified portfolio, I think people should also consider to incorporate the elements of inflation hedging, creating a bit more stable and sustainable income streams, and also to maintaining the potential appreciation into their portfolio.
It is interesting to hear the Hong Kong pension market consists of more than 50% of local securities. With these elements to be considered, how should people build or manage their own post-retirement portfolio?
Yes, absolutely. I think the key issue for managing your money in retirement is outliving your income. You need enough income so that you can avoid having to re-enter the workforce later, or otherwise do something drastic to meet your basic needs. And that takes careful planning in the beginning. So even if you do have a substantial amount of money when you retire, you cannot be too careful about this concern. And I do recommend 3 buckets to consider. The first one is cash reserves. So this bucket contains your cash and other short-term fixed income investments that can be converted to cash with little or no loss. So you can move these assets to a high-yield savings account to maximize what you're getting. Your reserves helps you to stay in the game with your long-term investments. The second bucket is for the intermediate term needs. So this bucket contains investments that you need for about 3 to 7 years out, and these investments can be weighted somewhat to safety. But given the longer time investment horizon, you can also have growth assets such as stocks here too. And the last one would be for long-term needs. And this bucket contains assets that you don't need to tap for 7 years or longer, and you'll be investing your money here into riskier, higher performing assets such as equity stocks. And the longer time horizon gives these investments more time to recover from the ups and downs of the market and go on to outperform. So the goal here is not to shoot the lights out, but rather than having a strong chance of solid long-term gains. So as you use your money in your cash reserve, you need to replenish it with cash from your other buckets as well. So if you're generating cash from fixed income investments or dividend stocks, you can move that from your other accounts to your cash reserve. But you can also harvest long-term capital gains and also to rebalance your portfolio at the same time. And as you manage your money, I think it's very important to remember to keep safety in mind. So that's both in the longer term and the shorter term. While it may feel safe to have all your assets in short-term income investments, you're likely to lose out to inflation over time. So on the other hand, you can't have all your money in stocks either if you need to use those cash in the short term. So it's important to understand the merit of striking a balance in between it.
Thank you for the advice to the public. It's really fruitful. At last, do you have any thoughts on post-retirement development in Hong Kong?
Yes, absolutely. It's one of the questions that are always being asked. So first of all, I think the government, the authority are fully aware of the labor force of, Hong Kong is rapidly aging. There's definitely a need, no doubt about it. The focus has always been on the current stage of what we call the pre-retirement stage via the existing Hong Kong MPF system, which from an investment standpoint, I think choices are very limited with restrictive investment guidelines, which may not give you the desired protection or outcome that you may need to serve the post-retirement purpose when you get to that age. This implies that the gap in between the start of your retirement day and to leave your post-retirement stage needs to be solved in terms of how much you need financially to maintain it. So currently there are quite some financial products, such as immediate annuities, inflation-linked bonds, for example, but may not be good enough to identify the financial gaps, with achieving the ideal retirement lifestyle. So in any sense, just a couple of my 2 cents. I think first thing is, relaxation of investment restrictions may offer a bit more flexibility from a yield return profile standpoint. The second thing is expanding the range of asset classes into alternatives, which was actually proven in many other global pension markets around the globe. And I think these could be topics that the industry and the regulator to examine and to explore in the long run.
Thank you, Anthony, for an insightful discussion on post-retirement financial planning. We all face retirement at some stage, so start understanding, learning, planning, and investing as early as possible. Finally, wish you all a fruitful retirement. Bye-bye.
Goodbye.